Mark, how you doing today?
Great, Ryan.
I'm looking forward to having you on the show. I've met lots of investment bankers over the years, and we have not actually had one on the show that is able to walk us through the entire process. Which after sitting down and talking to you, and going back through the history and all the different things that you've gone through, I figured, this is an awesome time to sit down and let's go from the start. And how do we select an investment banker and all the ins and outs? Because I think there's a whole lot of confusion from the entrepreneur's perspective, maybe not from advisors, but the roles of investment bankers versus brokers, how people get paid, when they should be hired, the different questions they should ask. So before we dive into it, let's give the listeners who don't know who you are a little bit of a backdrop. And you've been doing this for a long time, so give us maybe a little bit of the intro on how you got into investment banking, because I think that's an important part of your background and your perspective.
Yeah, absolutely. And I love, by the way, around what you guys are doing, just to bring focus and clarity and sort of cut through the noise out there in the marketplace, because it is so confusing for business owners. And I think that confusion is a big part of what led me to where I am today. Years ago, when I first finished graduate school, I was actually on the other side of the table in the sense of working in business succession planning, but it was more internal planning and keeping businesses and family. And as time marched on, I saw this huge void in the marketplace, particularly the middle market, which I'm sure we'll talk more later on about the different segments of the market. But I saw this big void that there were these large firms out there that served the stuff you read about in the Wall Street Journal. And then there was a lot serving the small businesses, but just not a lot in the middle market, particularly that served it in a way that brought a unified process and system and perseverance and passion to the process. And so that led me, after graduate school and years of doing really more internal succession planning, to create what ultimately became Vercor.
Well, and I think it's interesting too, because it's, you and I had talked about the fact that you were doing in the quote unquote succession as the estate planning, the tax planning, all the internal stuff. And so you have an interesting perspective that has also options in the overall realm of exits, but you decided to go the route of the investment banking, which I think is very needed in finding the right people that are out there. So, what's your definition of the investment banker? What role do they play? And let's kind of get some of the table stakes of the size companies and where the investment banker actually plays in the process.
Yeah, it's interesting, because you're starting off with one of the most confusing things of all, and that's just the term investment banking. What does that even mean? Because it means so many different things to so many different people. And I think it's confusing because it does encompass a very broad framework. It encompasses things like IPOs, corporate finance, debt financing, mergers and acquisitions advisory, so many different things. And ultimately, in the world that we operate in, investment banking, really, it's a segment of that. And that segment is mergers and acquisitions advisory services, which essentially means this. You've got really three groups of people that have three different objectives. One group is, I want to sell my company completely and I'm done with it. I'm tired of pushing the ball up the hill. I'm ready to move on and do something else. So that's an outright sell. Then you have the other group, which is, I'm excited about continuing to do what I'm doing now. I'm not burnt out. I have a lot of passion, but I want to take some chips off the table. I want to diversify. I want to diversify my portfolio. So that's what we call a private equity recap, where they're really selling part of their company and then they keep part of it. And then the third group are those that are looking to acquire a company. So those are the three broad groups that really encompass what we call M&A advisory, which is really a subset of investment banking. And then within that, you really have three types of investment bankers or M&A advisors in the marketplace, which I've already alluded to a minute ago. But basically, the three segments, let's bookend them with segment number one is what we'll call the Main Street segment. That's that segment that's the neighborhood dry cleaner, drugstore. Let's call that businesses that, let's say, would be under $5 million of transaction value. All right. And that's typically someone who's looking to buy a job. So that's one end. The other end of the spectrum is what you read about in the Wall Street Journal. That's the large transaction space. Well, let's call that 200 million in transaction value and above. All right. And then you have all this stuff in the middle, which is really you would get many different answers if you ask people to define it. But let's call it that 5 to 10 million on the low side. That's the very low side. That 5 to 10 is actually kind of a gray area, but say for sure the 10 to 150 million, 200 million size is what we'll call the middle market. And then that's further divided into what's typically referred to as the lower middle market and the upper. And that lower middle market is generally 10 to $50 million in transaction value. So that really kind of lays out the different segments of people that do what we do.
Well, I think it's awesome. A foundation that is super necessary because a lot of people don't know that and they don't know who they're sitting in front of. And even for some clarification too, because I think a lot of owners, and when you're talking enterprise value, I mean, a $5 million company could be $1 million in EBITDA times 5. So that puts you at that 5 million bucks. So, these numbers are what you're selling them and going to market for, correct?
That's exactly right. Yes, that's the actual transaction value. So that's ultimately what the person would put in their pocket at closing. And you're right. So that if you wanted to translate that to an EBITDA number, that earnings before interest, taxes, depreciation, amortization, the middle market generally starts at the 2 million EBITDA number and up.
Well, and it's so interesting, Mark. I was at this conference, and there's an investment banker, and there was a PE firm, and a couple other people, and they're talking about this stuff, and they throw up this sheet about where everybody plays, and most of the people in there are probably 5 million in revenue. 5 to 10 million in revenue.
Yes.
So you start to run these numbers and going, I'm not even sitting in front of the right person at all.
That's right. That's right. That's right. It's the thing a lot of people don't realize is that there's actually 3 distinct processes too that go into deploying how you get the job done. In the Main Street market, it's really much more akin to, let's call it, a real estate transaction or real estate process. And it's not bad or good. They're just different. A real estate agent's the ones that generally do really well. They have a lot of listings and they rely on a co-brokerage network to actually sell the listing. They're usually not selling their own listings. So it's a really high volume kind of a process. That's the Main Street. The large transaction process, when you think about it, there's not a lot of companies that can acquire Time Warner, right?
Mm-hmm. Right.
So there's usually only a small universe, and it's much more of a financial engineering process that goes into it. You can imagine the complexity of these multi-billion-dollar transactions. But the stuff in the middle market, it's really much more of a marketing methodology. The financials aren't that complicated. So it's really about how do you reach out into the appropriate segments, the appropriate universe, if you will, to find the right candidates who will have the right strategic fit. So it's a much more marketing oriented process in the middle market.
And that's a great way to put it and articulate it, because I've a lot of people go, "What's my business worth?" And it's, well,
Yeah.
your business is worth what someone's willing to pay for it, and that means it's more of an art, not a science. It's not just some number that your CPA spits out on a bunch of spreadsheets, which is a great benchmark, but it's not necessarily what someone's going to pay for it.
Oh, and you're so right in that. I mean, and you guys know this because of the great work you guys do in helping business owners get prepared and to really, bring focus into their planning. But, we know what all the value drivers are out there. And there's 20 plus value drivers that buyers look at. And what's interesting is when business owners, particularly in conversations they'll have with one another about, oh, what's your company worth? What's mine worth? They read an article, they went to a seminar. The reality is it's not just a simple matter of a multiple of earnings. It's things like, what's your customer concentration like? What's your trajectory like? Do you have good second line management? There's all these other variables that go into really establishing what the value is.
Well, and let's go and actually peel that apart, because I think you touched on it, and I want to really actually dive into it from your perspective because of how you guys go and the conversations you're having. And so maybe we're jumping ahead of the process, but I think because you brought it up is, maybe kind of give us some stories or an example, Mark, where because you have to go and you're representing the seller. So you're going in there and trying to sell it. Actually, let's not drive it, but let's make sure we come back to the value drivers, because I think that's towards the conversation that you're going to end up having with the potential buyers. But before we do that, maybe let's start with the process that you guys go through, because the value drivers is something that you having to pitch, and you're going to have to explain that stuff at some point. But maybe let's go back to what is the process that you normally go through, and in order to get that company ready and actually bring it to market.
Well, actually, the value drivers, you brought it up actually at an appropriate spot because it's one of the early things we do. Because step number one in our process, before we ever even consider signing an engagement with a client, is we do what we call a market value assessment. It's a gratis assessment that we do to determine what's a realistic value the company will bring in the marketplace. It's not a full blown valuation or appraisal. We could certainly do those. Those are very expensive. You don't need that. What we do is a very condensed version. It's something that we gather information from the client. We're going to get some historical financial information, some customer concentration information, some appropriate quantitative analytical information that we're going to get. But the second piece we're going to get is what we were just talking about. We have a value driver worksheet that we have the client or the prospective client complete, and they grade themselves on all these different value drivers so that we have a picture of where they're at. Because here's the thing, Ryan, this is that prospective buyers, they're not looking for perfect companies. They really don't exist. They're fine with challenges and opportunities because that's something that they can bring to the table to leverage and then make the company better. So step one is determining what's a realistic value range for the company in the marketplace today. And then secondly, it's then have a calibrating conversation with the prospective client to make sure that's within a range that they would be comfortable with. Now, we don't share that. We don't share that with prospective buyers ever. That's just an internal calibrating conversation. And then once that's done, it's engagement agreement signing. And next step is the fact finding. So we do a lot of fact finding, more quantitative information, more qualitative, so that we can prepare a deal book or a confidential information memorandum, as they're often referred to, a blind summary, and some other corresponding documents that we ultimately then use to go out into the marketplace, which is the next step, which is the marketing phase. And one of the things that we do to really add fuel to that part of the process is we look at it really through several different marketing quadrants. We look at one quadrant is who would be a buyer that would view our client as a new market with an existing product or service, because that's a synergistic fit that might get us more value. The second quadrant we look at is who's a buyer that will look at our client as a new product in an existing market. There's additional synergy that could be achieved there. And then the third quadrant is existing products and existing markets. That's the obvious low-hanging fruit competitors, if you will, in the marketplace. And then the last quadrant is what we would consider the private equity quadrant, which is there's not really any synergy there, but there's a long-term opportunity for the private equity group to bring strategic and sort of professional value to the equation. So that marketing phase is really the part where we're reaching out, we're exchanging information, we're screening buyers, ultimately landing on a small subset who we get letters of intent from, and then ultimately select the best letter of intent and move to due diligence and ultimately closing.
So, and I love the synopsis on those steps, and I want to actually kind of peel those apart a little bit, so that way the listeners can really get it under the hood look at this. Because even let's kind of maybe, Mark, go back to step one, and when you're talking about the value drivers and why these are important, why learning them are important, because how I've worded it in our presentation or in other interviews is the value drivers are essentially the opposite of the risk factors for the client or for the buyer, right? And so it's like, how transferable is your profit stream to someone else?
Yeah.
So how, when you're doing that, explain to us, like, why, how and why is it so important to know those before the buyers come in? Because and explain where you guys end up using those factors and those responses throughout the process.
Yeah, well, it first it comes down to one thing, and that is just simple self-awareness. I mean, the more self-aware a business owner is of who their company it really is today, what does it really look like to an outside person? Right? It's hard because it's kind of like your child. It's, people ask me about my children. I see them through a lens that's different than someone else would see them through. So having that outside party to really help you see through the lens, kind of take the rose colored glasses off and look at it with reality. Once you're self aware, then you have an opportunity to make improvements and make changes. Right. So you understand the value drivers. Now you see exactly where you grade along the spectrum. Then you know where you can really focus your energy on making improvements on those. And then last,
Some of those,
yeah,
sorry to interrupt, Mark, but
no,
like
go ahead.
some of those value drivers, I'm sure with all of the ridiculous amounts of deals that you've done, some of those you can't fix, and being aware of
Right.
them better not than not being aware of them, right? But some of them are going to be quick cleanups versus some of the ones that might take years. I don't know if you kind of
Yeah.
get a couple examples on how you handle, or a couple examples of one of those, each of those buckets.
Absolutely, yes. So we've got, in fact, those value drivers are broken up into internal and external value drivers. So you're right. The external ones you can't do anything about. For example, barriers to entry. That's a great example. There's not a lot you can do about that in your overall marketplace. There's either high barriers or low barriers to entry. But being aware of that helps you understand what you can and can't control as you go to market with your company. So that means a buyer is looking for a deal that has high barriers to entry. There's not a lot that's going to come of that, because that's not something we can change within your company. But I'll tell you a great example of an internal driver that is oftentimes missing in middle market companies is good, strong second line management. And that is something that you can change in relatively short order. I mean, it's not easy, but it takes time and a process. But good second line management, I'll tell you another great internal variable that you can change pretty quickly are strong standard operating procedures. The more stuff you have systematized, it's back to the point you made a minute ago, it's more transferable then. So anything that you can make more transferable is going to have more value to a prospective buyer down the road.
So as you're going and doing these value driver assessments and everything like that, how, like, I think there's a lot of timing misconceptions too that go on. Like, when should I hire an investment banker? What's the
Yeah.
process of picking one? And then how do people price them? Because I know I don't want to get too far, like, right down the pricing. What maybe this is a good time for, but some people charge retainers, some people don't, and how does that all fit into actually engaging?
Yeah, that's a very important topic. Let's tackle the timing and then the compensation piece the second. So the timing part, you get different answers in this, but here's what we tell people: if you want to be completely finished with your company, so you want to have a transaction and you want to be completely done, you better be started about 3 years in advance of when you want to be out, because it's not that uncommon that a deal will close and the seller will have some sort of transitional commitment. Now, if it's a huge company buying your company and you have a company with great second line management and great systems, then it's a lot more likely. But if you look a lot more like a lot of lower middle market companies look, not a lot of second line management, the systems aren't particularly robust. You may have a transitional period of time. You're probably going to have a transitional period of time of 1 to 2 years that is needed before you're really completely done. So that would be the longest period of time. So you need to start the process now if you want to be out 3 years from now. On the other hand, if you're saying, you know what, I want to do more, we talked about earlier, a private equity recap where you really sell part of your company and you stay on, then the process to get a deal done, Brian, as you know, is typically 12 months. That's a pretty good rule of thumb to take. So if you want to experience a liquidity event, then you better launch the process a year before you want to see that liquidity event happen. And then moving kind of to the second part of your question about compensation, which ties to selecting an investment banker, then you better start the selecting of the investment banker process, several months before you're really ready to launch a deal and have that launch date where you're a year out. And when you start looking at the different kinds of M&A advisors, investment bankers out there, you'll see a couple of different broad compensation schedules. Or I said within the different segments. So the Main Street segment, you're going to see generally a very, very small front end fee, maybe a few grand, maybe. And you have generally the performance fees that are paid when the deal closes are all over the map in the Main Street marketplace. Very different, though, as I said earlier, there's not a whole lot of front end work that needs to be done. But in the middle market,
But
you,
sorry, I mean, you
yeah.
could like started just on the Main Street just to make a range for people. Like, I mean, you could be anywhere between 5 to 12% of
Oh,
the deals,
I think, yeah, five would be unbelievably low in the
That's
main.
that would be like a friend
Yeah,
knocking on doors for you,
that's right. It's a friend doing you a favor. It's very common to see those in the 10% performance fee range in the Main Street marketplace. And again, that can change a lot depending on how aggressive that firm is trying to be and bringing on deals. But that's a pretty good range to think about. In the middle market, you're going to have front end fees, commitment fees, retainer fees, whatever you want to call them, that are going to be higher than 3 or 4 or 5 grand. They're all over the map. I would say a pretty good range is somewhere in the uh, 15 to 20,000 on the low side, up to 40 to 50 on the high side, depending on the complexity of the deal, depending on how big the deal is. Kind of that's a big range. But those fees are really primarily they're to make sure that the M&A firm wants to make sure that they have a buyer that's really committed. They're not getting rich off of those front end fees, needless to say, or at least generally speaking, they're
and
not.
it's your time or the investment banker's time to really see how well, what kind of hot mess are you dealing with, or how clean is it, right?
That's exactly right. And there's a lot of front end work that goes into it. There's the deal book, the blind summary. We prepare a very robust deal room, an encrypted deal room that has documents in it for exchange of information. So you want to make sure the client's committed and make sure that everything sort of set up in position to launch a program in the beginning. So you get front end fees that are somewhere like that. And then those are deducted from, if you will, the back end performance fee. And the back end performance fee is where that's our payday. That's what we're really in it for. And those, again, are all over the map. Sometimes they're tiered in many different ways. But if you take a formula fee of 5% of the first 10 million, and then 2 to 2.5% of everything above that, you can slice it many different ways and have varying different tiers. But if you total that number up, you're going to end up at somewhere in that range, generally speaking. So if you lined up, let's say 100 M&A firms on a $20 million deal on the fee schedule I just gave you, that would be somewhere between, call it $700,000 and $800,000 back end fee. And if you calculate it with that sort of 5 and 2 or 5 and 3% formula, you could come to that 700,000 or 800,000 different formulas, but it's going to end up somewhere in that range on a $20 million transaction. Now, the higher the deal gets, when it gets up to 50, 80, 100 million, the percentages go down, significantly as you start getting up into the higher valuation range. But just as a kind of a quick sort of perspective, a $20 million deal would look something like that. And then you minus from that, you deduct from that whatever the front end fee that was paid.
Well, and this is probably a good segue too, because a couple things that I want to, as I'm thinking back in my old perspective when I was sitting at the table, is one is, holy shit, that's a lot of money. I should do it myself. And then the other one is, so I want to address what your thoughts are on that, and the risks of not going with an investment banker versus going with an investment banker. But before we do that, I want to circle back to what you were talking about in the timing. And I completely agree with you on the 3 years. And how often do you have it happen, Mark? And I know a lot of investment bankers do, and I've seen the owners do it too, where they call you when they want out in 3 months. And how do they, so the person that wants out this year, what are they actually dealing with? And how do you actually handle those calls?
Yeah, you're right. That is what we get the vast majority of the time is they're ready to take action now. And certainly, in an ideal world, what we wish is that they had taken steps long before that to position their company better and to make it much more appealing and much more presentable and to have the value enhanced well in advance of that. So the answer to what we do depends on what their objective is. We try to be very objective driven and not agenda driven. And so if it's a buyer, if it's a seller that wants to be out now because he is just tired of pushing the ball up the hill and he didn't want to push it up any further. Or he may see some external variables on the horizon that he's concerned about, any number of personal variables like that.
Hmm.
Then what we have to work with, Ryan, is whatever it is at that particular point in time. And we help them understand the picture today, and here are the strengths and growth areas, and here are the weaknesses, and here's how this is going to impact the deal. And that's just something they have to accept. Right. Ideally, though, what's happened is it's been years before that. And they go, you know what? I see in the future, this is something I'm going to want to do in a few years. So what can I do today to position my company to achieve maximum value down the road?
I think that pretty much answers what I was kind of thinking, and I'm gotta imagine your hardest part of your job, and every investment banker or broker out there is, okay, so yes, I am tired. The industry is taking a shit, and I do want to do something else, but I still want full value for it.
Oh man, you Ryan, you've got that is the number one challenge is calibrating expectations, because you're exactly right. It's like, and not only full value, but full value plus plus plus, because they read an article somewhere and someone got a multiple, or worse than that, they took a phone call from someone. Oh my gosh, that just happens all the time. And this someone said, "Oh, we're paying X," and they're all they're doing is using a bait and switch ploy, and that's not really realistic. So we have to really drive hard, and we're one of the things that we really focus on at Vercor is setting and managing expectations. We're just simply not willing to tell people what they want to hear and then have them be disappointed at some point down the road. So there's a lot of tension that we have to manage when it comes to that point right there.
Hmm. Yeah, and I think that bait and switch comment that you made is a nice dovetail back into the value of having someone in the middle of you and selling. And maybe let's get your bait and switch definition and example, because I think that's happening a lot right now.
It is happening a lot, and it's been happening for a long time. And in the simplest way to the simplest example to give you is someone calls you on the phone, and they say, generally what they say is, we're representing someone who's looking to buy, and it's nuanced. They'll say a company like yours. They won't necessarily say you're a specific company. And the client, the seller, the business owner gets excited. Oh, really? Yeah. And they go, well, what kind of value looking at? Because I'm not really looking to sell unless it's a home run. And the person goes, well, it's that they it's not uncommon for them to pay multiples of 6 to 10 times, to which the business owner goes, that's exciting. And the person goes, great, now let me send you the information we need. uh, and look, I wrote a whole book about this. We get about all the mistakes that were already made at that point in time, but then they start sending them information. And then here's what happens, what I like to refer to as the death of 1,000 paper cuts. Over the next 3, 4, 5 months, the business owner gets worn down with information requests. And then finally, what happens, the buyer says, oh, you know what, we've discovered this thing here or that thing there. Now we can't pay you that value. It's going to be X, which is 50% less than they were expecting. And now the business owner falls victim to, well, I've invested so much time, I hate to see it not happen. And that's basically the most common bait and switch example.
Yeah, and which is, yeah, and I got the stomach ache of when that happened to us multiple times. And it's it because by the time you're mentally gone, like you can't sell
Yeah.
and continue to run your company and do all this stuff, and all of a sudden you're like, yeah, I got a multi-million-dollar payday, and like, wait a second, totally distracted,
Yeah.
numbers decrease, and you weren't ready. But the other reason that I've been seeing this is there's so many private equity firms and non-deployed capital, the dry powder that's sitting on the sidelines, where people have to spend this, but
Yeah.
they're not. So they're essentially distracting these owners all over the place. And I think this is going to go back to the role that the investment baker plays, and how you guys go to market to pay for your fee. Is
Yeah.
that these people want to avoid going through that because they can get a good deal. And I interviewed this gentleman, Ryan Moran, last week, and he articulated it wonderfully. He said that as owners, you think that they have the prize, which is the check, when the reality is you have the prize, which is the cash flow. So
Yeah.
I think these
That's right.
owners need to
Yeah.
realize that they have the thing that everybody wants. So if you flip the power dynamic, you should be able to get what you want if you go through the right process.
You're right, and I think what happens so many times is business owners, there's a couple of misnomers out there, and one is they think they're hiring an investment banker to get them more money, and you know what? That's likely going to happen. But the reality is, the big thing they're hiring them for is what you just alluded to a minute ago, and that's managing a process, because the process starts from the very first time your phone rings, right? And so an investment banker knows how to manage the process. They understand the obstacles, the pitfalls, the opportunities, where to push, when not to push. I mean, the list is endless. And that's really what you're hiring an investment banker for, is to manage the process the right way. And the byproduct of that is likely a higher value, but also another byproduct of that is getting the deal done. Because when you don't know how to manage the process, oftentimes you just don't get the deal done. And that's the other byproduct is getting that. And then thirdly, what you just talked about a minute ago, it's a massive distraction. If you don't have an M&A advisor managing the process for it, it's a massive distraction. So they manage the process. You as a business owner keep running your company. That's where the win is.
So I agree with you, but I'm going to give you probably the perception that most of the listeners have is,
Yeah.
well, I was at a trade show and I know this guy or gal or this
Yeah.
supplier, and they already made me an offer. So like, I've already got the process. I already know them, and we're just going to get the deal done and not have to pay you guys.
Yeah, no, that's good. That's great. And I think it was either the third or fourth chapter. I think in my book I wrote years ago, "Selling Your Business the Easy Way," is negotiating with one buyer at a time. One of the biggest mistakes people make, because here's the problem. That sounds great. They're going to provide an offer, and it sounds good and it's wonderful. Oh, that's fantastic. But what you don't know is what the marketplace would really pay for your business. What if it was 30% more, 20% more? What if it was a better structured deal for the same value? There's all these things you don't know because you only dealt with one buyer. So the idea is to have multiple parties at the table at the same time. Then you're getting maximum value. You're getting a deal that's structured the best way, and you've maximized the likelihood of getting it closed. But you're right; that is a very common, response that we encounter.
Well, I just like it to if someone knocks on your house and says, "Hey, I'll buy your house," and if you haven't listed it and you don't know if the market's hot, not hot, what do people want,
That's
and all
right.
that stuff, then
Right.
you mean you might get the deal done, but you have zero idea how much you left on the table or if it's the right buyer, etc.
That's right.
Um, so maybe Mark, let's go into like, how do you take it to market? Because I think there's also a lot of people out there that just hire an M&A advisory friend who knows people in the industry or knows connections or something like that, versus someone that only has a small Rolodex or a big Rolodex or just PE firms or strategic buyers. Like, what is the definition of, in the real estate? It's putting your house on the market. In the main street, it's, they throw it on their website and they've got listings
Yeah.
for the sub 10 million.
Yep.
How does your process or any other process like that work, and what questions should people be asking about the investment banker's process?
Yeah, in the middle market, it is a fairly inefficient process in the market as a whole. So in the large transaction space, like we talked about, there's only a few buyers. So as a result, the buyer will likely be in your Rolodex, right? Acquiring Time Warner, that buyer was in the Rolodex. It wasn't some big mystery as
Mhm.
the small universe of people. In the middle market, I mean, there are hundreds of prospective buyers. The likelihood that the buyer for any individual deal is going to be in the M&A advisor's Rolodex, it's not that high unless you're really niche driven. I mean, let's take for example just someone that focuses on the IT space. Think how broad that is. I mean, there's so many subsets of that. There's application development, there's IT services, there's staffing, there's cybersecurity. The list is endless. So unless you're really refined into a deep, deep niche, it's unlikely the buyer is going to be on your Rolodex. So, why your question is so important. And I think that's what business owners have to ask is, how do you go about marketing a deal? And first, it's a tremendous amount of research using sort of that grid approach. that I talked about earlier. And really, it just comes from the old business school days of the Ansoff marketing matrix. That's all it really is, but it's intentional. And I think you find the vast majority of M&A firms, what they're looking to do is just go after one quadrant, the low-hanging fruit, the obvious people. Well,
Hmm.
anyone can figure that out. We want to spread out into the additional quadrants of potential strategic buyers that aren't in the Rolodex. And that requires just good old fashioned research, man, just really digging deep, building an outreach set of contacts who fit, who would fit good strategic, synergistic acquisition, and then contacting them. And you know what's interesting? Acquisitive oriented companies, they love to hear from investment bankers because that's how they get a good half of their deals is from investment bankers in the marketplace. So that research and marketing outreach is really key. It's not just going after the obvious low hanging fruit and making 10 or 15 obvious calls.
Well, and let's dive into like what happens when you actually how you're doing that. Because like let's say you got a few hundred, you've done all this research of this one company. There might be the strategics, there might be the different geographic locations, there might be the different products and services and competitors. So explain how what the sim is, because there's a lot. I can't believe how many people don't know what that is, and then
Yeah.
how that integrates into your marketing approach and what the buyers are actually reading and why what's important to them.
Yeah. So the first thing they get, actually, even before they get the SIM or the confidential information memorandum or deal book, as it's sometimes called as well, is the first thing they get is a blind summary or an executive summary. So we assemble a little one pager that has enough information to communicate the value proposition, to communicate the opportunity, but not denoting or disclosing who the company actually is, because people have to get something before they're going to sign a non-disclosure agreement. So the first thing they get from us.
What's on that blind summary?
So the blind summary is going to have some summary financial information, revenue, COGS, expenses, EBITDA number. Very summary though, very very
Hmm.
concise. Last 3 years, maybe trailing 12 months. It's going to have some broad location like Northeast or Southeast, not the city or state generally, because that would give away who the company is. It's going to have a historical brief narrative, maybe a paragraph or two, and then there's going to be a narrative about the service or product offering of the company, and then whatever the larger value proposition of the company is as well. That's the kind of things you're going to find on the executive summary. And people get that, then they say, oh, I'm interested or I'm not interested. Then the buyer signs a non-disclosure agreement at that point in time. And once that's signed, that's when they get the SIM or the confidential information memorandum. That deal book has it can vary a lot from anywhere from 10 or 15 pages to 30 or 40, depending on the kind of deal and the complexity of the deal. But imagine that is a document that has, usually it's a deck in a deck format that they kind of evolve over time as to what buyers are interested in seeing. But that's going to have operations, history, more in-depth financial information, management, marketing. It's going to hit all the key functions of the company so that the buyer now has a clearer picture, at least, of what the opportunity is. And that's after a non-disclosure agreement has been signed.
Well, and what I love about that, and I'd love your feedback or your thoughts, because like I went through that process, and you just kind of go, oh, we should have been running our company like this a long time ago.
That's exactly right, man. It's
So, because like
so
in there, you're pitching your company, right? I mean, and I
it's
think
right.
that's why a lot of these startups that are raising money, they always have their exit strategy in the pitch book because people want their money back. But a lot of the entrepreneurs, they never really thought about it, so they never really thought from the end in mind. But and how does that? I mean, because it isn't the sim. I mean, it's the value drivers, right?
It is. That's exactly right. It's value drivers. It's basically pulling up in front of your house, and what's the first thing people see? That's the deal book is the first thing they see, and it is. It's unfortunate that business owners haven't spent more time in advance preparing painting their house, right? Replacing some of the dry rot, and doing some of those kinds of things, figuratively speaking, of course, to get their business positioned, in the best possible way.
So what are, as that sim goes, well, maybe let's, what is the quantity of outreach people should be expecting, and how many people got outreached, how many NDAs, how many sims, and then let's pick it back up, which is, I'm assuming, due diligence or something like that after that.
Yeah, and how many deal books are going to go out? It's a lot of times going to depend on the deal. Let's compare and contrast, man. Let's say you have a technology company with a strong monthly recurring revenue stream. Okay, that's going to one that's going to be in very high demand. You might have 50 to 70 deal books go out. I mean, we've seen more than that, but I think that wouldn't be uncommon at all. Certainly, you would have you know probably 35 or 40 is on kind of the low end, up to 60 or 70 on the high end. Deal books go out. There's a lot. Now let's contrast that with a company. Let's take a construction company that's a purely project based, no recurring revenue, no anything, just purely eat what you kill. Chain, it's
Hmm.
seasonal, ebbs and flows. A typical company like that, you might have uh, 15 to 20 deal books go out. And of course, there's outliers, but I think that's a pretty good perspective to get when you think about how many deal books would go out
Well,
on.
it's interesting, Mark, too. I'm assuming the quantity of deal books that go out also represent the value or the multiple of EBITDA people get.
Oh, absolute, no question about that. Those are definitely directly correlated for sure. And once the deal books go out, the next step after that is this process of information exchange, depending on how enthusiastic the buyer is. So we have this deal room online that's set up and populated, I referenced earlier. So we give people access to certain parts of that, depending on their enthusiasm and how we view them as a quality buyer. At some point, though, we're going to get to the next step, which is going to be a conference call with the client, not a plant visit, a face to face, but a conference call. Now, the buyers want to get face to face as soon as possible, but that's not something that we let happen early in the process. The conference call, we're only going to let that happen when we've had some understanding from the buyer as to how they view value. So if their perspective on value is vastly different than what we're expecting, then we're not even going to get to that step. But as we narrow down the funnel from the deal book, so if there's 40 deal books that go out, there's going to be a good half of those that have significant interest. And out of that half that has significant interest, there's probably going to be half of that. So maybe somewhere between 8 to 10 that we would end up doing conference calls with our client. And those are generally an hour and a half long, where they get to ask some key high level gating questions to the client in a conference call format. And then subsequent to that is more information exchange. And then we get to the letter of intent, term sheet, whatever descriptive phrase you want to use. But we're going to at that point get term sheets and letters of intent, or some refined communication of how they're viewing the value of the company. Then it's plant visit time. We're going to select down from that group into a much smaller group, and there's going to be somewhere from 3 to 5 plant visits on a typical deal. There could be more than that, but typical deal, 3 to 5 plant visits. Then it's time for final letters of intent, and then we negotiate all of those letters of intent at the same time, and then ultimately select one buyer. And then you move into the part that's not so fun for the client, due diligence phase. You know what that's like, Ryan. You've been there before. And that's I liken it to a root canal without Novocaine, but you've got to go through the process to get paid. I mean, you just have to, for someone's going to wire you a $20 million, $30 million check, they have to dig into, your records. And that's a
Mhm.
90-day process, due diligence. Everyone tells you they're going to get it done in 45 or 60 days, but that's rare. It's usually 90 days from signing of letter of intent until you get to closing.
So I really appreciate you clearly walking through your process, because that's how it should go, and that's how everybody should do it. And here's just a little joke, because here's what happens. People go to a trade show, they say, sure, let's do this. They say, here's the information, can you send it over? The potential seller sends all the information, all the financials. They got no leverage, they got no control, and they're immediately sitting there without anything.
Yep.
Because like you said, like even having the conference call of having you say, what is their definition of value? So you're not just giving away your financials and all of your negotiation chips. It'd be like
Yeah.
trying to play poker by showing your hand immediately.
That's right. That's right. And the business owners, they make the very first mistake they make is even engaging in the phone call or the conference when someone says their answer really should be, "Let me connect you with my advisor, and he'll be happy to talk to you." Because the minute they say yes to anything, answer any questions, do anything, in fact, even the phone call, they've already open themselves up to a breach of confidentiality because you know the game and how quickly word can spread. So
Hmm.
that's another big part that business owners oftentimes shoot themselves in the foot by taking that phone call and not having an advisor. Is the minute they do that, now someone knows they're potentially interested in selling their company, and that person on the other end is not bound by confidentiality. They can
Hmm.
share that with anyone.
Hmm. So the LOI, I think there's a lot of gray area and how people handle it, where they see it in the process. I've seen a lot of people say, well, I've got an LOI, and they think the deal's done. And
Yeah,
then you had mentioned the fact that you have two different steps of the LOI. So what is your definition, and like in maybe even elaborate, Mark, on what you mean by terms? Because I don't think a lot of people like realize that $20 million isn't just $20 million. There's a lot of terms and conditions that come with it.
yeah, that's right. And yeah, it's funny because I wish I had a nickel for every time someone said, "Oh, I had an LOI for X. I could have sold my company for that." And I'm thinking, no, that doesn't mean anything. But you basically there's three main phrase or abbreviations you'll hear: IOI for indication of interest, LOI for letter of intent or letter of interest, and then term sheet. Those are the three main ones that you hear most often. And we use those terms kind of loosely throughout the process because the early phases of what I'll call the LOI, it's oftentimes not even an LOI. It could be something as simple as an email outlining, here's sort of our initial thinking, because the buyer oftentimes doesn't want to, invest a tremendous amount of forward energy and time if they don't feel like they're at least in the broad ballpark as well. So sometimes it's just an early, it can be an email, it can even be a phone discussion where someone's outlining it. We just have to get some perspective to understand how they're viewing value to determine, is it really worth keeping them engaged in the process. But when the time comes, which is, can like I said earlier, it could be before a plant visit or after a plant visit, just depending on the situation. There's a formal document that generally is anywhere from 2 to 5 pages long that list. There's really two broad types. One type is very specific. It goes into reps and warranties, indemnification, all kinds of stuff. Then the other type is much broader. It just says we expect to negotiate definitive purchase agreements that are going to have all these various items in them, and that's the more common one. And that letter of intent doesn't bind or obligate the buyer to anything except confidentiality. The seller is typically bound by exclusivity, meaning during that 90-day time frame, they can't talk to any other prospective buyers. And that basically provides the energy or the fuel to ultimately move to the purchase agreements. And the definitive purchase agreements, which encompass the actual asset or stock purchase agreement, employment agreements, non-compete agreements, all those documents, those are the ultimate things that until those are signed and money's wired, you don't have a deal. The letter of intent is just a framework for saying, this is what we both are working toward. Now let's see if we can get there.
Hmm. And the due diligence, all those documents that you talked about. I mean, that's just the seller trying to say, okay, is this actually what I'm talking about? Is this like, does the president have a non-compete or not? Right? I mean, it's like
That's right.
do the suppliers and the vendors have agreements? I mean, it's because if they're going to pay 20 million bucks. What's the risk with that, right? I mean, so how have you, what are some of the biggest mistakes that people have as you go, or maybe mistakes or eye openers that they have as they go through that due diligence, and how does that reflect the terms and conditions and price?
Yeah, I think the biggest thing is organization. There's the more organized a business owner is with their sort of material that they have. And this is back to the comments, sort of a theme throughout here that we see oftentimes is getting business owners prepared in advance. I mean, that's just so important. Well, this is one of probably the biggest thing business owners aren't prepared for is due diligence. And in an ideal world, they're in advance, they've already gone through and had sort of a mock due diligence done, and they have documents prepared, they're organized. That's in an ideal world that can happen, and that can happen, obviously, with the right planning and preparation in advance done. And so when they're organized, then it creates a sense of confidence and a sense of trust for the buyer. The more disorganized, oh, I don't have this, oh, don't have that, let me see if I can find that. It creates a sense of lack of confidence. That's all. And
Mm-hmm.
so I would say where it translates more to than value is getting the deal done. So if there are too many sort of nicks that the buyer, let's put it this way, if there are too many emotional withdrawals that the buyer has to experience, then they start to get buyer's remorse, like anyone would. So the more organized and together the documents can be in advance, it's going to create more positive momentum. It's like a sporting event, and in some regards, momentum is very important.
Yeah, I mean, it's all I can think of is, so we sold one of our branches years ago. Years before we sold, so that's a long time ago now. But
Yeah.
like, hey, can you give me these employment contracts and your vendor or the Canon license agreement for Duluth? And you're just like, I think
Yeah.
that's in the file cabinet in the storage room
Right.
for our first
Yeah.
house because it's been 25 years.
Right. Yeah. Or we have a handshake. We don't really do. We just have a handshake back then. Not really a big deal. Yeah. No, you're exactly right.
So, as you look through that process, then, and what is when you're finalizing the terms and conditions, who's got to stay? Maybe what are some of the biggest terms and conditions that people should be aware of? Just to kind of contextualize that. So how long people, whether it's the owner or other key executives, how long they stay, or what escrow or different deal creative structures. What are some of the things that people should be aware of that will be implicated or impacted by the due diligence?
Yeah, some of the things. First, thinking at the sort of big picture, the purchase agreement. The big part from a legal standpoint of the purchase agreement is a list of all these promises you're making. So you're making a lot of promises, and they're all reasonable promises, or promises that you should be comfortable making. They're everything ranging from I promise that I own this company to I promise I haven't fraudulently provided you with information. I mean, they're reasonable promises, but you make all these promises. Obviously, the buyer wants the promises to be phrased in a way that benefits them, and the seller, our client, we want it to be phrased in a way that's very refined. For example, I'd be happy to promise that I've always owned the company. That's an easy promise to make. A promise I would not be willing to make is there's never been an environmental spill of any kind in the history of this piece of property. That's an unreasonable promise. The buyer would love something that broad, that they're not going to get that, but you can't promise that that's not happened on your watch while you've owned the property, right? So it's finding that balance between the promises. And the second big part is, what are the consequences if your promises turn out not to be accurate? So that's another big aspect, is there have to be consequences, and those consequences have obviously monetary value to them. So that leads then to, how does the buyer go about collecting if any of those promises are broken? And one of the ways they do that is to have some sort of a holdback or escrow, where they will take a portion of the deal, and this is a negotiated point, some percentage of the deal, and they'll put it in escrow for some period of time. That's a negotiated point as well. Maybe it's 6 months, maybe it's a year. and that's it's negotiated as to how long and the percentage. And as long as all the promises are kept, then you get that money at the end. If some of the promises aren't kept, then there's rules about how that money is distributed to the buyer if those promises aren't kept. And then there's lots of little derivations and combinations, things like, well, you don't collect until the value of my broken promises reach a certain amount. Below that amount, it's kind of like a deductible. So there's a lot of different combinations and and variances that come along with that.
Well, and I'm just going to put a plug in for all advisors out there because, my dad and I did a lot of this stuff on our own, and I watch a lot of people do it. I've seen it, and you get the the bait and switch, or the bait and switch, or whatever you want to. I'm screwing it up right now, but you get the term that goes, the number that goes out there, and then you go through all this stuff, and you can kind of see, as you've very articulated it so well, Mark, is that all the things that the people that you need on your team to be able to protect you from the people that do this all the time through due diligence,
Yeah.
minimizing the price. And then like that whole last purchase agreement is what people, when I've interviewed people after the fact or talked to people, they get totally screwed in this because they don't have the right attorney that does M&A.
Yeah.
They don't have a CPA or an investment banker that's protecting them from just accepting the first sheet that comes across.
That's right. Yeah. And thank you. Because using an M&A attorney is so crucial. It can't just be, just the regular attorney that you use, who I'm sure does a fine job for you, but it's a different art form doing legal work on an M&A deal versus, just a standard, contract, if you will. It's a very different art form for that. So it is crucial.
Yeah, this is not a master service agreement.
That's exactly right. You're right. And I think having an M&A advisor quarterback that process, because as the business owner, they have no idea what is reasonable and unreasonable. And that's a big part of what we're trying to do, is to quantify what's reasonable, what's unreasonable, and then make decisions accordingly.
So I know we're kind of probably getting to the time of wrapping up here. Well, Mark, we've talked about a lot of stuff, and I think, it's one of the clearest ways of someone going through the process and where the investment banker fits and everything. Is there one part of this that you want to like highlight and say, this is one thing that you should take away, or if there's something that maybe we missed that you want to leave our listeners with, what would it be?
Well, the biggest thing really would be get prepared in advance. I mean, wherever you're at today, get prepared in advance. I mean, even if you're not even thinking about selling your company for years, take some time now and just get prepared and organized and understand what your picture looks like, what your business looks like to a third party, to someone that's not internal. I mean, that's really the biggest thing. The more prepared you are, the better the process is going to be, the better the value is going to be. And then I think the second thing is even if you're not looking today to do something, don't be shy about interviewing some firms, and find a firm that you can engage with now that can be a part of your team, so that when you are ready to pull the trigger, you have someone that's already come alongside you and ready to take action.
Yeah, it's building the relationships before the actual trench warfare starts.
Yeah, absolutely.
Well, and I think also, Mark, to kind of finalize that too, is like, even if you're building relationships with multiple people and multiple firms, people's in your industry, people jump ship and switch shops a lot, and everybody's resources are different and or workloads, right? If all of a sudden we got to a point where like someone said, hey, we're doing 3 deals right now, and even though we knew them, they couldn't do it.
Oh yeah.
It's really understanding that, like, people shift around between different firms if they might have been working with someone, but also people's workload, and there's a lot of activity going on right now. So let's say you and I had a good relationship for 2 years, and all of a sudden you're doing 3 deals, you might actually not physically be able to take another one on.
That's right. Yeah. And you hope that, and that's true. And that can be particularly challenging when you're dealing with like a one office operation. Actually, this is kind of full circle to, why I started Vercor to begin with years ago. It was also that in the middle market, it's hard to find firms that share the same values that we do, but also have a national footprint. So, and since we've got offices around the U.S., it would be difficult, for example, for us to be at a spot where we didn't have capacity to take on deals. But that is a challenge when you're dealing with kind of a one office operation can be a challenge, is not having the capacity for sure.
Yeah, I think it's just build the relationships now and, go into it with eyes wide open. What's the best way for our listeners to get in touch with you?
Yeah, best way is email, of course, first, mark@vercor.com, which is VERCOR, V like Victor, ERCOR.com. Sidebar, Vercor is the name of a mountain range in Europe. And when we started it, it was all built around, we're a guide. It's kind of like we're taking you on a mountain climb and we're going to do all the heavy lifting, but you come along for the journey. So that's the sort of history behind that. But mark@vercor.com. My direct line, 770-851-9952, is also a great way to reach me as well.
Mark, I had a blast. Thanks for coming on the show.
Thanks, Ryan, for having me. It was great hanging out with you, man.